Hi there, everybody. Happy Thursday, January 30th. Welcome to Chart This with Dave Keller. I'm your host, Dave Keller, coming to you from kind of an overcast, but still beautiful Redmond, Washington. Hope you're all doing well, staying warm, staying happy, finding joy despite market uncertainty wherever you're at. And I appreciate you so much joining me here for our show today. As a reminder, we're live streaming on YouTube, X, Facebook, LinkedIn. I appreciate those of you tuning in live. You can ask questions at any point during the live stream. At the end of the show, we'll take a question or two. We have an all mailbag episode planned for tomorrow. Some really good questions already have come in, and we'll try to include as many as we can. But keep them coming. Always have appetite for more questions. With that in mind, kind of a choppy, sloppy conditions in the market continue to change, or continue to be a very real experience for investors. End of the day, net higher today for the S&P, making it more and more likely that the January effect, which is the idea that so goes January, so goes the year, looks pretty good to have a strong finish to January, at least strong enough to keep the major benchmarks in the green. And that usually leads to a strong performance through the course of the year. It's not guaranteed, but certainly helps when January's down, and much more mixed results when you look at the long-term history in the markets. Breadth today quite good, although it was kind of defensive stuff at the top of the list. You're going to find sectors like utilities, healthcare, REITs. Those are the kind of sectors getting it done on a relative basis today. The FANG sectors in some way struggling through earnings, I guess I would say, at the bottom of the leaderboard. But all 11 of the S&P sectors finishing in the green. It's kind of an interesting day to break things down. And let's get to our market recap. Looking at the major averages, the S&P 500 up 0.5% to 6071. The Dow still below 45,000, but getting closer, up another 0.4% today. The NASDAQ up about 0.25%. That's the NASDAQ composite we're talking about. The NASDAQ 100 up a little more. So the S&P, the top performer out of that group of major U.S. benchmarks. Again, kind of speaks to the lack of dominance of technology and other growth sectors this particular week. It's been about the other sectors that have really started to perform quite well. Don't look now, but mid caps and small caps outperforming the S&P 600 and Russell 2000, some of the better performers today. The small cap S&P 600 index was up 1.1%. The VIX drifting lower. We're now in a 15 handle, 15.8 at the end of the day. Again, mid-teens means low volatility. VIX is saying, move along, nothing to see here. Market conditions are just fine. An environment like this, when overall, we're not making new highs generally, although some stocks certainly are, looking at Meta and others, Raytheon, right, making new highs this week. While the major averages, the S&P and the NASDAQ, kind of not yet making new highs and eclipsing their highs from the last month or two. When the market overall is still in a position of strength, which on a medium-term, long-term basis certainly seems like the case, I'm always looking for signs of deterioration. I'm looking for signs that I should not be so optimistic. And one of the things I would look for would be a spike in the VIX. And while that doesn't guarantee a huge sell-off, it's incredibly rare, if not almost impossible mathematically, that the market would start to sell off and that volatility would not increase. So it's one of those great red flag indicators to just keep an eye out for. The spike in volatility usually means risk assets are struggling. Not today. We've been in the mid-teens here for a while, and that's where we remain. Looking at interest rates, you can see basically the entire yield curve kind of drifted down today. The 10-year point finished just above 4.5%. The long bond yield is now below 4.8%. I had a really good interview earlier today with Jay Hatfield. He's the CIO at Infrastructure Capital Advisors in New York. Still editing up that episode. Hopefully we'll get it out for you tonight. We'll say probably tomorrow morning, I would say, would be a reasonable goal for that one. But a really interesting conversation about interest rates, about the Fed. I would say Jay was not light on opinions about Chair Powell and Trump policies and different things that he saw as key factors to keep in mind. A lot more discussion about tax policies and corporate tax rates as opposed to tariffs being the most important thing coming out of the Trump administration, which is not a sort of a comment I've heard very often. So I'd encourage you to check out that episode once it's released and see what you think. The dollar index dead even from where we were on Wednesday's close. Strong dollar, of course, definitely could weigh in on big tech earnings through the course of 2025. No further upside today. Precious metals having a decent up day, while stocks essentially were chopping around net higher. Gold and silver continuing to push higher. We've showed the chart of gold here, at or near new all-time highs. Silver in a position of strength as well. Silver ETF SLV was up 2.6%. Gold was up another 1.5%. Crude oil basically flat, and other areas of the energy space like natural gas actually in the red today. So that nets out to the commodity group as a whole, which is a pretty diverse group of things, right? You got metals, soft commodities, energy, a bunch of different things all kind of mixed together, but it sort of netted out to a neutral day for commodities. Big up day in gold, I think, and silver, I think, are pretty key there. Looking at crypto land, all green. The top 10 coins followed on the stock charts platform, all showing some strength. And again, despite stocks kind of, being choppy, a little positive today for sure, but overall kind of a sloppy week, cryptocurrencies kind of getting it done so far. Bitcoin currently trading just above 105,000. It's up about 1.3%. Ether prices above 3,200. That's up another 4%. You can see that the rest of the top 10 coins all in the green today. All right, let's look at the 11 S&P sectors, and you can see it was defense at the top of the list today. So again, days like today maybe feel different depending on how your portfolio is tilted. And if you've developed kind of a growth tilt to your portfolio, and probably not surprising if that's been the case, because if you bought equal shares of technology names and healthcare names and REITs and materials, your technology weight is probably huge because they've done so well for so long. And so as the prices appreciate and as they outperform, it becomes a bigger bet in your portfolio. And that's why a lot of times money managers will trim on the way up just to, make sure they don't have a huge over allocation to some of those sectors if things get out of whack from their target allocations. Days like today show how that can be a risk, because utilities were up 2.1%, arguably kind of a growthy sector in recent months and over the last year. Really, since last spring, we've talked about the energy requirements of all this mining and AI stuff that's being done. All requires a ton of energy. Utilities are all of a sudden part of that growth story. And so up another 2.1%. Real estate, number two, up 1.3%. Healthcare and industrials both up about 1.2%. So that's all defensive value at the top of the list. At the bottom of the list, there's your growthiest of the growth, XLC and the XLK, communication services and technology, slightly higher, 0.1 to 0.2%. Energy is third from the bottom, up about 0.5% today. Looking at breadth conditions, boy, breadth was overwhelmingly positive today. If you look at the S&P 500, 8 out of every 10 S&P names were in the green today. That is a bullish day in terms of breadth. And that shows you, the equal weighted S&P does much better than the cap weighted S&P on a day like today, because some of the biggest names were not the biggest gainers. We're used to the opposite happening. We're used to the benchmarks going up, driven by the Magnificent Seven. And even though breadth can be weaker because a lot of other stocks are going down, the benchmarks still go up. Today, we kind of changed that narrative with most stocks going up, and some of the few that were not were in some of those growthy sectors. So it's kind of flipping that narrative we've experienced. You can also see that comparing on the breadth between the S&P and the NASDAQ composite as just an initial comparison, right? 82% of the S&P members advanced today. Only 60% of the NASDAQ composite members advanced today. Again, still more than half, but definitely a big gap between what the S&P did, which obviously a lot more value stocks represented when you think of it on an equal weighted basis, versus the NASDAQ composite, primarily growth oriented, of course. All right, looking at the growth leadership names, what we call the Magnificent Seven and Friends. Look at this, Tesla at the top of the leaderboard. It's been a while. Tesla, good to see you there. 2.9% in the green. Alphabet, number two, 2.8%. Meta, up 1.6%. Now, two of those names, Alphabet and Meta in particular, have been some of the great success stories here in the early days of 2025, kicking off the year in a position of strength. Arguably, two of the strongest, if not the strongest. Maybe I'd put Amazon up there as well as some of the stronger names. But look at the bottom of the leaderboard, or the bottom of the list, with the Magnificent Seven, and you can see the pain that was ravaged on Microsoft. Microsoft earnings today down 6.2%. Yesterday was Microsoft, I believe, down 6.2%. Amazon down 1%. Apple down about 0.75%. Apple reporting today. We'll look at the after-hours session briefly, time permitting. But, post earnings, you're seeing, at least today, Meta continuing to make new all-time highs. Market is basically telling you that all this AI stuff everyone's worried about is not affecting Meta because they are doing just fine. And the way that they are, planning, sort of evolving through this period is okay. Microsoft, on the other hand, down 6.2% right after earnings. All right, let's get to the market carpet, the heat map style visualization. As a reminder, I can see your questions as you're coming in. I do see a couple questions coming in on YouTube. On X, we'll often get some questions as well. Anywhere you're streaming, I appreciate it. Put your questions here as we go on. We'll grab a question or two at the end of the show before we wrap for the evening. Looking at the market carpet again, if you cover, Microsoft, Salesforce, and ServiceNow, kind of those three bright red boxes on the left part of your screen, maybe cover up Apple as well. This is a pretty good day, right? 80% of the S&P members were up, and you can see that here by the fact that the average color is kind of like a mid-color green, a mid-shade of green. It's a pretty strong up day. Now, other things to think about, obviously technology in the upper left, I would argue probably the weakest of the bundle as I'm looking around, maybe communication services as well, in terms of the general configuration of the heat map. And it's some of these names obviously struggling quite a bit. I mentioned Microsoft. Salesforce is down 3% today. ServiceNow, one of the worst performers, down about 11% today. The problem with ServiceNow is it's coming off of a new all-time high yesterday, right? So yesterday's close, we're pushing to new highs. Today, we're kind of coming back down a little bit. I'm going to go off script a moment just to look at the conditions on ServiceNow. This is what I was thinking. I was going to say, I thought ServiceNow was one of those tech names, a software name showing a clear bearish momentum divergence. I tell you, this is why I often point these out, because when you see a stock making new highs on weaker momentum, right? So higher highs in price December to January, weaker peaks in momentum. We're overbought there in mid-December. We are very much not overbought here over the last week. So you have a stock pushing to 1,200, but the momentum is waning. And so what that suggests is that the bullish kind of momentum, right, the buying power, the mo that's keeping this stock going higher is starting to dissipate a little bit. And I have learned to be optimistic when you have stocks making new highs on stronger momentum, because that tells you there's sort of like additional juice being popped into the stock as we make new highs. And a lot of bull markets, continued bull market phases kind of experience that. But when you start to see that last new high on weaker momentum, I've learned to, start questioning the sustainability of the uptrend. We've seen that in the month of January from, financials come to mind right off. Going into earnings, you had some really good earnings releases. But weaker momentum on the new highs. You're now seeing that on some tech names like ServiceNow. So today's gap lower obviously hurts quite a bit. This is a stock that reported earnings yesterday. So today gapping down on the open. I mean, the good news is we're kind of testing the swing low from early January. That's right at the ultimate kind of big round number support, 1,000. So for now, kind of at a tactical point, a pivot point where you might expect some support. We break below 1,000 though, and I think this is when you probably want to definitely get out of the way of. Here's the way I generally think of a stock making a major top. The usual kind of textbook three parts of that are: number one, we make a new high on weaker momentum. That's strike one. Number two, we either gap lower or pull back off of that new high and test support. That's strike two. We break support is strike three, and then you're out and out figuratively and literally. That's when I would probably be exiting positions, or at least lightening up and finding other places to put my capital. Think of charts as whether they deserve your capital or not. I would say if a stock like ServiceNow breaks that support level right at 1,000, which is a common place where stocks tend to find support, can be a problem. All right, looking elsewhere around here, what else stands out? I mean, again, on a day like today where everything's green, where kind of the average color is green, you see how the red just automatically kind of pops out. And this is what I love about a heat map kind of visualization. Yesterday, if I remember right, it's kind of a neutral day for the benchmark. So bright green and bright red totally stood out, right? The bright colors were just so unique. Here, you kind of have the average stock having a decent day, which means anything down means something's up. And so when I see Caterpillar, down about 4.6% after yet another failed attempt to gain a foothold above $400 a share, that's not great. UPS making a new 52-week low today, down about 14%. That doesn't feel good. Robert Half is another one, breaking a new swing low after a lower high around 71, now undercutting the low from earlier in January. So those are the kind of names I would absolutely be looking at, just to see, just to see what there is to see. By the way, and just see what sort of names stand out for doing something different than the broader indexes. Those are some of the general takeaways that I would say overall. Again, kind of a strong day. And if you just ignore the relatively small number of stocks in the red, the average stock had a really strong day. So hopefully your portfolio did the same. All right, we'll finish off doing the chart review portion. I appreciate some of the questions. Also a good OH. I give you an IO back for that. I promised I wouldn't talk too much about Ohio State, but you started it, putting it in the chat, so I feel fine sort of following up with that. Looking at the daily chart of the S&P 500, we continue to just toy with this gap range. The gap here is what I'm talking about, shaded in green. I should probably change these so they're not both the green shading, but this one in particular, you have, the upper end of the gap around 60.80. The lower end of the gap is around 60.20, we'll call it. And that's the gap that we experienced last week. Then, of course, we have Monday with the open down at trendline support trading higher, Tuesday trading higher. Yesterday, a bearish inside day. Today, kind of a nice bullish resolution, actually breaking out and getting right to the upper end of that range. I mean, it's literally testing the low from that day last week, the beginning of that downside gap. So I would say at this point, gap now filled, and the question is, do we build momentum above there? I think of gaps as a support and resistance range. So I would say we're still within that resistance range. I can't give an all clear just yet. I think this is a bullish chart yet again. When we break out of this range to the upside, which means we need a power above 6,100, and that would complete the bullish rotation. S&P overall, I mean, is setting up quite nicely, and it's an interesting contrast to stocks like Nvidia and others that are not setting up particularly well at the moment. They're not horrible, they're not broken charts yet, but they're certainly not going up the way that the major benchmarks are doing. Day like today is really driven by kind of the other stuff. It's like the generals are faltering, but all the infantry are actually providing the upside momentum. 8 out of every every 10 S&P names in the green today. The momentum's still not excessive, right? I mean, we're not seeing a big spike in momentum. We're not really seeing a big spike in volume. When I'm looking at things like chicken money flow, it's still kind of wait and see mode. So let's see. Now, here's the thing. If you've listened to my podcast, and I hope you have, it's been a lot of fun. We're in the process of rolling out podcast episodes every day or two to the major podcasting platforms. So Spotify, Apple, wherever you get your podcasts. I'd appreciate you following the Market Misbehavior podcast, sharing it with your friends, getting some eyeballs on it. That'll help me make that more successful and hopefully get some better and better guests that I can sit down with. But I talked with Sam Stovall not too long ago. I talked with, who did I speak to? Jeff Hirsch last week as well, kind of the king of seasonality, as I would think of it. Jeff and I and Sam as well talk about the January effect, right? Looking at the first month of the 12 and what that tends to mean when we have a strong January. The short answer, the Cliff Notes version, if you're old enough to know what Cliff Notes are, the Cliff Notes version are strong January usually means a good year, right? I mean, a year that has a positive January usually has a positive 12-month return. A weaker January, a down January does not necessarily mean a down S&P for the year. It's more of a coin flip, right? Because most years are up, but a strong January is usually a pretty good sign. Barring some huge sell-off tomorrow, which again is possible, but unless that happens, looks like the S&P is going to pound out another positive January here for 2025. This is the year-to-date return so far. You have the S&P up about 3.25%, small caps up 3.4%. NASDAQ up 2.3%, bonds, and I'm using the TLT as a proxy for the bond markets, up 1.1%. And then you can see where else? Gold. So those are the things that are up, right? So the S&P 500 up, that's good. But let's look elsewhere. We can see that gold is up 6.6%. That's usually using the GLD. So that's a proxy for physical gold, not gold stocks. But physical gold. And then you can see Bitcoin, by far the top performer, up just almost 13% year to date already. So overall, again, positive January for the S&P 500. That usually means it's called the January effect. And again, I go back to my interview with Jeff Hirsch last week on the podcast, where we talked particularly. He actually talks about the January trifecta, looking at three different seasonal trends between the Santa Claus rally, the first, we call it the first 5 days or the first 7 days. I'll let Jeff, the expert, tell you about that, but it was a lot of fun. And then the January effect as well. So overall, looking good for that positive sign for the year. S&P 500 breadth today quite good. And I would say one of the things we observed through the course of this week, particularly yesterday as we came off a bit in terms of the stocks above the 50-day moving average, was would we see enough stocks hold their 50-day that would remain constructive. Today's positive breadth certainly making that seem like a likely scenario. When you see that indicator break down below 50%, just means we're probably in a pullback phase of some sort. Again, stocks have rallied nicely off of their lows from earlier in January in terms of the major benchmarks. The question with breadth is, are the individual stocks participating as well? This is telling you it's actually, pretty constructive. And as long as that remains above 50% going into next week, I think that's a pretty strong signal that breadth is strong enough to maintain the gains that we've experienced so far in the last couple of weeks. The long-term breadth has been pretty consistently strong regardless. All right, looking at the AAII survey data from the AAII, the Name Exposure Index, usually reported Wednesday. So Thursday is a good time to sort of check in on these weekly sentiment readings and just see where they're at. If you look at the data here, so here's the S&P on a weekly basis. Here we have the percent of bulls and the percent of bears. You can see in green and in red. This week, slight decrease in bulls down to 41%, slight increase in bears up to 34%. And so overall, kind of a little group going from bullish to neutral and some going from neutral to bearish would be my general assumption. We're still net positive, net bullish, I guess, between the two. But we're down around a 7% gap between those two readings. A couple weeks ago, we actually went net negative for the first time since briefly in April, but really since the fall of 2023, which is sort of the last most painful drawdown that we've experienced for the S&P 500. So overall, that sentiment going back positive, but the bullishness not being at a euphoric level, I would say that's overall a fairly constructive sign in sentiment. Extremes in sentiment can be a contrarian signal to pay attention to, but 41% bulls is pretty healthy. That's kind of like a good but not concerning level of bullishness. All right, the Name Exposure Index coming down quite a bit this week. Last week, we had spiked from around 70% up to around 85, 86%. That was one of the biggest increases in the Name Exposure Index we'd seen in quite some time. It usually actually is part of an impulse move to the upside when a lot of money managers rotate very quickly to more of an offensive positioning. Today, though, or at least when we check the data today, given all of that back. Now, of course, this is coming through the course of this week where a lot of growth stocks got dinged pretty good. While the S&P is going to be a positive month for it's going to have a positive January, a lot of stocks may not, or certainly that is very much in question. And looking at semiconductors and other names like that have seen some weakness this week, and others like Microsoft dropping down there. So looks like the weakness in tech and some of the headlines that we've seen causing the Name Exposure Index to go right back and actually below where it was 2 weeks prior. So down around 68%. That's a little under average for this data series going back over multiple years. But not by much. So overall, last week looked like stepping on the accelerator. This week, more stomping on the gas again. So you're seeing the Name Exposure Index get whipped around pretty good. And I think that reflects very much the sentiment that you see in these markets. I feel like we go from day to day, from euphoria to desperation. There's no middle ground, right? We're sort of all or nothing, feast or famine with how this market feels. All right, we'll finish off looking at some individual names. I'll take a question or two before we wrap up. So NVIDIA, again, I mean, it's, a day like today, not bearish in that we didn't break down, a little more bullish, similar to yesterday, in that we traded below the 200-day moving average, but did not hold it. And we're keeping NVIDIA and semiconductors on the daily chart list just to keep an eye on this, because I think it's a pivotal time here. So, I mean, if you think about what's happened, this is when NVIDIA gets a huge valuation downgrade because of the DeepSeek AI news out of China, From there, we have gone nowhere. We have literally stayed within that day's range. So what that tells you, at least what it suggests to me, is that we are still not sure what the impact is going to be. And I have heard competing headlines within minutes of one another. One headline, one author, one expert saying this is just the beginning. This brings the whole AI, bull market into question. If NVIDIA and NVIDIA chips are not crucial to AI, if we don't need this much energy, apparently, then why are we bidding these stocks up so much? And that's obviously pretty bearish for NVIDIA and for the semiconductor space. And then immediately after, I get, this is nothing. The bottom is in. That was it. Be buying now because you get a great company like NVIDIA at a steep discount over a short period of time. Still undetermined. And I think the fact that the chart of NVIDIA is literally exactly where it was on Monday tells you everything you need to know about the conclusion here. It's still an open question. I think where we go out of this range is probably going to be pretty meaningful. The problem for the chart of NVIDIA is if we do get a little bit higher, we're right back into this range that we've been since October of last year, right? We're really range bound going into this week. And so, we've gapped lower, but we're still, we're still below some pretty significant overhead resistance. The 200-day moving average for me is crucial. Holding that through this week is pretty meaningful. And I think this stock above the 200-day moving average is, while down quite a bit, is still okay. NVIDIA breaking below its 200-day moving average and following through, getting a valid breakdown, I'd be pretty concerned here. If you unwound some on this day because of the gap, I don't blame you at all. If you use any sort of trailing stop, a gap of 20% or so is probably going to trigger it. And that's fine. I don't have a problem with following a very systematic approach like that. The question is, if you still hold some, do you see enough on this chart to say, I want to get out of the way? And I would say you're not seeing that gap and fall pattern, which tells you absolutely get out of the way. Don't think another moment. And you also don't get that gap and run where we gap and then you see buyers coming in. You're not seeing that happen either. So I would say still an open question. I've not seen enough evidence to tell me what this configuration means, except we're unclear as to what the next direction might be. Now, if you look at the SMH, which is obviously NVIDIA and then a bunch of other semiconductor stocks, a little more constructive, because I would say at this point, as a swing trader, we're kind of at the lower end of this range. We have not broken 235. We've not broken the lower end of this consolidation. So I don't have a problem playing that going back to the upside here. So it's sort of a little different structure technically than you see with NVIDIA. But same thing. We break below 235, which would get us below the 200-day and below that lower end of the consolidation. I personally, I'd be out. I don't own NVIDIA or SMH specifically. I probably own plenty of ETFs that have exposure to semiconductors, but no direct investment that I would be unwinding a position based on that. That's how I would think of those charts from a technical perspective. Now, we've talked a lot about some of the other Magnificent Seven names. I just want to point out Microsoft, dropping pretty good here today, down about 6.2%. This is not great. Now, Microsoft has arguably been definitely in the bottom half of awesome technology or awesome charts within the Magnificent Seven. I mean, it's nowhere near Meta and Alphabet and others that are just clear outperformers, clear leaders within that group. Microsoft, Tesla, these are charts that are struggling. Apple, these are the outliers. And I would say looking at the chart of Microsoft, I mean, the good news, if you're more of a contrarian, is we're getting back toward the lower end of these levels. We're getting near a 38.2% retracement. Let me jump into the chart here because I don't remember what time frame that's drawing that from. Let's bring a little more data in. When in doubt, zoom out is what I was taught. All right, so we look at like a year and a half. That'll take us to the beginning. So this is going from the September 23 low up to the July 23 high. 38.2% of the way is 405. Yeah, and I remember this. This is the lows from September, from October, from November of last year. We're kind of right down in that range. So again, it's not breaking down just yet. I think breaking there, that's where I would be thinking short, bearish option structure kind of bets, because we're not able to hold support. The bad news for Microsoft is we're making a lower high, but we haven't broken down yet. So this is a neutral chart for now, but very close to a breakdown. We're testing support as the RSI is testing 40. That holds, and it's not too bad. We saw that here in January and there in October and here in early October and here in September. That's why we look at price support and look at momentum to see if it holds that bullish range. But if we break 40 and we break support, that's the kind of thing I would be out of the way and not think another minute, find other places to put my capital. Apple reporting, where was it? Today, right. Let's look at the after hours in a moment here, but you can see going into today, this is really in limbo between two moving averages. You have the 200-day below right around 220. That's also the swing low from January. The 50-day moving average just above current levels, 240. Going into a report like this, I think we break out to the upside above 240. We break below 220. That's the direction that I would bet on. Whichever way we break, the direction of momentum, that tells us the new move, and that's what I would probably trust. If it's a positive release, you're immediately looking back to the previous highs. If we miss earnings, you immediately need to hold that level, and if we get below it, because that would be below the January low, 220, that would be below the November low, around 220, and also the 200-day. Man, I would be out of the way of that quicker than you can say something. All right, let's look at Apple. So after hours, yeah, so not bad. It's actually coming up a little bit here, about 3.6% higher, so around 246. So currently Apple's around here. So breaking back above the 50-day moving average. I mean, that's where we open tomorrow. I think that's a pretty good reaction. That's a bounce off of support at 220, never getting below the 200-day. If we follow above the 50-day, I think that's a great chart to at least ride to a retest of the December peak around 260. Would not be a bad outcome if Apple's able to pull that out on a week when some stocks are getting dinged on earnings big time. You know, Nike, I mean, I got four more. Sorry, I got a bunch more charts. We'll go quicker. I thought this was the last one. Sorry. Nike testing a big double bottom pattern. And again, Nike is not a great chart. It is below a downward sloping 200-day moving average. I think there are much better charts out there. I would much rather own a Meta versus a Nike from a technical perspective, because I like charts that are in primary uptrends that are demonstrating their ability to outperform. I don't like charts like this that are basically going down. I was taught price goes down for a reason. And so, again, wait for signs of accumulation. But one of the ways you can often identify that a stock is in a bottoming phase is we start to, we stop going down, basically, right? We find a low, and then we retest that low. On the weekly chart, this is a very clear double bottom pattern from the July-August low to the low from earlier this month. So if you're more of a contrarian and you're thinking, I'm buying Nike around 70, 71, or even, to current levels and just holding it unless it breaks below 70, that's my stop. I have no problem with that as your approach. I generally don't tend to trade that way. I would much rather wait for a break above the 200-day. So a stock like this, I basically set an alert, tell me when it gets above the 200-day, and then I go do something else, because there are other charts that are stronger that I probably want to own. But if you're a contrarian, I would love the fact that you see a test of support. I would love the fact that we've rallied off of those lows. And I love the fact that the RSI is pushing above 60 this week. I think all of that speaks to some initial strength off of the lows for Nike. Coke is a tough chart. I actually wrote about this for CNBC Pro earlier today. So if you follow my work there, hopefully you read this. And if not, I would go check it out. But I think Coke may be setting up for a really compelling breakout. Think of it like the Nike chart, which has been going down for a while. This is the daily chart of Coke. It's been going down. We made lower lows November into January. But if you look at what's happened in the last couple of weeks, we've made a higher low. We make another higher swing low. We're trading a bit higher. I think this is a really compelling chart above 65, 66, because when we get above there, that would mean we're eclipsing the 200-day, the swing high from November, the first Fibonacci retracement level. I'm not a huge fan of taking a shot until we get above there. For me, that would prove that there might be some sustainability to the uptrend. Would also want to see stronger momentum. Would also want to see things like the chicken money flow continue to improve, showing that there's additional volume power or pressure pushing the price higher. So from my analysis, it's a little too early. Again, you may approach things like this differently, be a little more aggressive, totally up to you. But for me, this is an interesting setup, kind of not quite there, but this would be the level I would be looking for. This is why I would set an alert at 66. And I'm going to write down a note to do that, because I often say I'm going to set an alert and then I forget to do it. So we'll do it after the show. Caterpillar, disappointing a bit today. Earnings today, you can see gapping lower about 4.6%. This kind of completes, I think, a failed breakout above 410. Really looked encouraging as we were testing 410 again. Maybe we're setting up for a head and shoulders continuation pattern, but not there yet. And so I think this chart above 410 is compelling. Below there, I'm not particularly keenly interested. Lululemon breaking above the final Fibonacci resistance. Look at the daily chart from January. This is really December of 23, the low from August of 24. 38.2% around 336, 61.8% around 405. We stalled out there in December, stalled out there a couple times earlier this month. We have now broken above there. I think that's a great chart, getting better. Seeing more and more retailer names showing that kind of follow through. Las Vegas Sands, I mean, not a great chart yet. I would say today's gap is pretty encouraging, though. This is a stock making lower highs and lower lows until today. We have gapped above the 200-day moving average. That's good. We've gapped above trendline resistance, taking the December peak and the early January peak. Do we hold that tomorrow? That would be the question on LVS. Again, to sort of convince me that that has some sustainability. And then let's finish with a position of strength. Raytheon reported earnings on Tuesday of this week. Chopped around earnings. Now, they're reporting earnings in the middle of this kind of technology dislocation thing happening, but this aerospace name, again, pushing to a new all-time closing high today, right around 129. I think that's a strong chart in a compelling space, pushing higher. You have a president who's most likely going to have policies which are probably good for a company like Raytheon. We'll see, but from a technical perspective, new highs are bullish. That's what I was taught as I was learning all of this. All right, we're going to take a question or two, and then we will wrap up. Sean Smith, let's see. Thanks for watching on YouTube, Sean. He said, how do you feel the Trump tariffs that were announced near the market close will affect the market tomorrow? News to me, Sean. I was preparing, looking at a bunch of charts. I don't know a lot about what particular tariffs were announced, having not seen anything specific that I would want to comment on. I mean, I would say, in general, so I had a very specific point of view on what tariffs would mean based on everything I've read and people I've talked to up until earlier this morning. I thought of tariffs as being inflationary, right? Because what tariffs would mean if the U.S. is imposing some sort of tariffs on goods from outside the U.S. I can't imagine how those tariffs would not be passed on to consumers in the form of higher prices, and that by definition is what inflation is, right? Is that prices would go higher. So I think that could be a concerning issue. My conversation with Jay Hatfield earlier today changed my thinking a little bit. It was actually really interesting. Again, I'd encourage you to have a listen once that's released later today, probably tomorrow morning. But two of his points: number one, he sees tariffs more as political talking points. He thinks the reality will not be as negative as a lot of people have portrayed, which is, a fair guess. We don't know. Still an unknown. But the second thing he said, remember that while tariffs are inflationary, that also means a lot more revenue for the U.S., right? I mean, that is, going to turn into more revenues coming in. And so that probably is good for companies in some way. I'll let Jay, give a lot more color and thoughtful work behind those two comments that I made. So I can't comment on tariffs in particular. I've not seen the headline you're talking about. So my comment is I don't think it's going to be a big deal until I learn more about what that is. But generally, I would say tariffs less of an issue. After my conversation with Jay, it kind of changed my thinking a little bit, and I would encourage you to take a listen as well. What Sean C. Okay, thank you for the follow-up. Canada and Mexico 25% each. Trump announced during the close. I think, it's so fair. I'll look forward to more of that, and as soon as I can comment with a little more understanding, I'll be happy to share some insights with you. I mean, generally, I would say there's always a gap between the announcement and what it actually will mean. I was very focused on the inflationary inputs. We'll see. We'll see what it actually, how it's actually translated. Let's see. One final question. Thanks, Connecticut. Been there many times. Enjoy it. How constructive does your gut feel SOX looks to fill the gap? Yeah. So with the SOX, I was looking at the SMH earlier. Let's look at the SOX to see. And pretty similar. I see what you're saying about this gap right here. Yeah. Let's take a look. So all the semiconductor stocks, the SMH, very similar. I kind of think anytime you can draw a rectangle around the price action, think of it as what I would say a consolidation phase. I think of the market at any point in one of three phases. We're in an accumulation phase, meaning we're making higher highs and higher lows. We're in a distribution phase, meaning lower lows and lower highs. We're in a consolidation phase, which means highs and lows kind of even. I can draw a rectangle that captures 95% of the price action over the last 6 months or so. that's a consolidation phase. That is a sideways market. The market is telling you, semiconductors are worth about this much, right in the middle, the midpoint, and we're just kind of fluctuating around that level. The moving averages are almost dead flat. The RSI is rotating between 40 and 60. All of these things from a technical perspective tell you we're going sideways. So, what are the chances that we close the gap? I mean, we're bouncing off of the lower end of that range, which means betting for a move further into the inside of that makes a ton of sense. The 200-day moving average would be the immediate place I would think would be in the short term where I would look for some sort of resistance. But I would say the larger story, which for me is where I often want to keep my thinking, is this is more about a range. And I think this is a really constructive chart when you break out here. It's a very negative chart when you break below there. But until we push above 235 or below 210, we're still going that painful third directions. Markets can go up, markets can go down, markets can go sideways. And it seems to me that semiconductors are doing that third and frustrating option if you have a directional bet on a stock or an ETF like SOX. That's it for today, folks. Thanks so much for watching our live stream. I appreciate some of the questions I did not get to. I'll put them in the mailbag. We're planning an all mailbag episode tomorrow, and I appreciate so much you tuning in. Keep the questions coming. Much appreciated. Also, check out our podcast episodes. Some really good interviews here recently. This week has been a fantastic one with some really knowledgeable guests, and I hope you enjoy the interview with Jay Hatfield, which we'll be putting out here probably tomorrow. And then earlier in the week, I'm blanking because I've had a couple discussions here. Peter Bookvar, that was released on Tuesday. That was a lot of fun too. So this week we've had Jeff Hirsch, Peter Bookvar, and Jay Hatfield. Some really good guests. We've had some really good suggestions, by the way. So if there are others you want me to interview as part of the Market Misbehavior podcast, just let me know. For Market Misbehavior, I'm Dave Keller. Have a great night, and remember, it's always a good time to own good charts. Take care, folks.